Picture this, it's 6:47 in the morning, you haven't had coffee yet, and your phone is doing that thing where every notification sounds like the one before it except louder. You open it. Red banners everywhere, breaking news, global conflict, markets plunging. And your first thought before you check on your family, before you even process what's actually happening, is your brokerage account. You're not alone, that's not a character flaw, that's what financial anxiety does to a person. It hijacks every instinct you have and redirects it toward a number on a screen. But here's the problem. The action most people take in that moment, the thing that feels like being proactive and smart and responsible, is statistically one of the most destructive financial moves a person can make. And I can prove it with 100 years of data. My name is Miko, and I spend way too much time thinking about how money actually behaves when the world feels like it's falling apart. If you're someone who has ever watched geopolitical news and felt that specific cocktail of dread and helplessness about your portfolio, make sure to hit that subscribe button and give this video a thumbs up if this helps you out. Because what I'm about to walk you through is the exact order a financially prepared person invests their money when a major global conflict breaks out. Not what feels right, what the data says. And those two things, as you're about to see, are almost never the same thing. The biggest lie the news tells you about war and markets. Here's the thing, before I show you a single investment, I need to dismantle something. Because if I don't, you'll hear everything I say and still do the wrong thing when the moment arrives. There is a business model sitting between you and rational financial decisions during a crisis. It's not a hedge fund, it's not a foreign government, it's your television, and your financial news app, and the push notification you set up 6 months ago that felt useful at the time. Here's how that business model works. Financial media makes money on engagement. Engagement spikes during fear. The more alarmed you are, the longer you watch, the more you click, the more ad revenue gets generated. Your panic is literally their product. I'm not being cynical, that is the structural incentive. So when a major conflict breaks out and markets drop 2% and the Chiron reads global markets in FREFALL, understand what is actually happening. A 2% drop is not a freefall. It is a Tuesday. It has been labeled freefall because freefall gets you to turn up the volume. Moderate pullback, consistent with historical conflict patterns, does not get the same ratings, never has. Now you might be thinking, okay, but the news is still reporting facts, right? The market did go down, that part is real. And yes, the number is accurate. What is not accurate is the interpretation layered on top of the number. The implication that this drop is the beginning of something catastrophic, that this time is different, that the pattern which has held across 110 years of market history is about to break. Here is the data point financial media will never lead with, because if they did, you'd turn the channel off and go make breakfast. The S&P 500 has delivered positive one-year returns following 73% of all armed conflicts since 1945. The Dow gained 50% during World War II, 60% during the Korean War, 27% during Vietnam. The market has now survived 2 world wars, a nuclear standoff, multiple assassinations, a debt ceiling crisis, and a global pandemic. At some point, the evidence speaks for itself. Here's what most people don't realize about why that's true. Wars are, economically speaking, the most aggressive government stimulus programs in human history. The moment a country enters a major conflict, it begins spending without a ceiling. Weapons, fuel, logistics, food supply chains, communications infrastructure, medical systems, all of it flows directly into publicly traded companies. The government becomes the single largest customer on Earth overnight. And it does not negotiate on price. That money has to go somewhere, and it goes into earnings, which goes into stock prices. The investors who have fared worst in every major conflict of the past century were not the ones who held. They were the ones who sold into safety and then watched the recovery from the sidelines in cash, which was quietly losing purchasing power the entire time they waited to feel calm enough to get back in. The psychology trap, why panic selling feels like genius. I want to spend a moment here before we get into the investment framework, because this is the part nobody talks about. You can know every statistic in this video and still make the wrong decision, because the wrong decision won't feel like the wrong decision, it will feel like clarity. Here's what panic selling actually feels like from the inside. It doesn't feel like fear. It feels like you've finally seen through the noise. The market is falling, the news is genuinely bad, the situation is uncertain, and selling feels like the rational, adult, responsible move. You hit the button, you feel a wave of relief, you've done something, you're not just sitting there watching a number go down. And then the market recovers. Maybe not immediately, maybe it takes 3 weeks, but but it recovers because that is what markets do. And you're on the sidelines holding cash that's losing purchasing power by the day, trying to figure out when it's safe to get back in. And your brain's answer to that question is always the same: not yet, not until things settle, not until there's more clarity. By the time there's clarity, you've missed the snapback. JP Morgan quantified this precisely, and the numbers are jarring. A $10,000 investment held in the S&P 500 from 2005 through 2024 grew to $71,000 if left completely untouched. Miss the 10 best trading days in that stretch, 10 days out of roughly 5,000, and you end up with $32,000. Miss 30 days and you're essentially at break-even for 20 years. Here's the part that should permanently change how you think about crisis volatility. 7 of the 10 best trading days in any given period happen within 2 weeks of the 10 worst. The crash and the recovery are practically the same event. The person who sells during the crash misses the recovery. It's that mechanical. The financial media knows this. They cover the crash breathlessly for a week. They barely mention the recovery because a recovery is good news, and good news as a business model is basically worthless. So, with that established, here is exactly what a prepared person does in order, and the order matters. The framework: 6 steps in sequence. Let me introduce you to 2 people. Call them Jordan and Alex. Same starting point, $45,000 in index funds, a stable income, similar financial news habits. Same morning, same alerts, same red banners on their phones. Jordan sells everything by 8:30 a.m., feels smart. Alex reads one data point, turns off the TV, goes to work, and makes 3 specific additions to an already structured portfolio. We'll come back to where their money ends up, but first, here's the framework Alex was working from. Step 1: the cash floor, 6 to 12 months of expenses, not more. Before a single dollar goes into any investment, you need a cash floor. 6 months of living expenses minimum. 12 if your income is variable or your job has any real uncertainty attached to it. Here's the specific structure that actually works. The bulk of it in a high-yield savings account or government money market fund earning something meaningful. And this is going to sound slightly extreme: $2,000 to $5,000 in physical cash at your actual home. I know, stick with me. When Russia was cut off from the SWIFT payment network in February 2022, Russian citizens woke up to non-functional ATMs, not because their money was gone, because the digital infrastructure that moves money was switched off. Cyber warfare is the documented first strike tool of modern conflict, and its most effective target is payment infrastructure. Physical cash for a few weeks of expenses is not prepping. It is a hedge against a 3-day banking disruption. That distinction matters. Now here is the critical part: this is also where you stop with cash. Buffett has said it directly. Holding excess cash during wartime is one of the worst things you can do with money. Wartime inflation averages 4.5% historically compared to 3% in peacetime. Every dollar beyond your emergency buffer sitting in a savings account is quietly evaporating while real assets appreciate without you. Build the floor, stop there, move on. Step 2: gold, 10 to 15% of investable assets, but not for the reason you think. Here's the instinct most people have about gold in a crisis: buy it now because the world is ending and gold survives the apocalypse. That instinct is right about the asset and catastrophically wrong about the timing. The people who bought gold at its January 1980 peak during the Soviet invasion of Afghanistan waited 26 years to break even in inflation-adjusted terms. 26 years. The people who bought at the 2011 debt ceiling peak lost 30% over the following 2 years. The pattern across every modern crisis is identical. Gold spikes on fear, then gives back the fear premium when the worst case doesn't materialize. If you're reading a headline about gold hitting all-time highs, part of the move is already behind you. This is where it gets really interesting, though. Right now, gold is elevated, but not primarily because of fear. It's structural. Central banks purchased over 1,000 tons annually starting in 2022, the highest levels on record. That is not panic buying. That is institutional repositioning by sovereign wealth managers diversifying away from dollar exposure. When that is the driver, the move has a different duration. The practical vehicles, IAU or SGOL, both holding physical gold at near zero cost. Keep a small slice, maybe 5% of your gold allocation, in actual physical coins, not for the apocalypse. For the 2-week scenario where digital infrastructure is disrupted and something tangible has immediate transactional value. The point is, gold should already be in your portfolio before the crisis is on the front page. If it isn't, add it now, size it correctly at 10 to 15% and resist the urge to triple it because you're scared. Oversizing an inflation hedge is still a mistake. Step 3. Defense 10 to 15%. This is the trade history hands you every time. Look, I understand this one is uncomfortable for some people. Profiting from weapons manufacturing doesn't fit neatly into most people's self-image. I get it. I'm going to give you the data and let you decide. Raytheon gained 37% in the week following 9/11. A $10,000 investment split across the top 5 defense contractors on September 18, 2001, was worth $97,000 by August 2021. Lockheed Martin has returned over 1,200% since the War on Terror began. In 2022, while the S&P 500 lost 18%, defense stocks outperformed by 28 percentage points in a single year. European defense stocks have surged 260% since February 2022. Poland is currently spending over 4% of GDP on defense, double the NATO target. Germany, famously pacifist for decades, approved a €100 billion special defense fund essentially overnight in 2022. The EU as a bloc has broken its own defense spending records every year since. Here's what most people don't realize. This is not a short-term war trade. The order backlogs at major defense contractors, RTX, is sitting on over $200 billion, Lockheed on $160 billion, would take years to work through even if every active conflict ended tomorrow. This is a decade-long structural shift that a geopolitical crisis accelerates but didn't create. The cleanest ETF is XAR, equal weighted, so you're not betting everything on two companies. It has returned over 20% annually for the past decade. ITA is more liquid but top-heavy. XAR gives you better diversification for the same exposure. Step 4. Energy 10 to 15%. The script never changes. Every major conflict of the past 50 years has involved an energy shock. Ukraine sent Brent crude above $130. Tension in the Middle East puts immediate pressure on the Strait of Hormuz, which carries 13 million barrels a day. The mechanism is consistent. Conflict restricts supply, panic drives premiums, and energy companies print cash. In 2022, when the S&P 500 lost 18%, XLE, the energy ETF concentrated primarily in Exxon and Chevron, gained 64%. An 82 percentage point gap in a single calendar year. That is the largest divergence between energy and the broad market in the ETF's history. Note what financial media was covering in 2022 instead of mentioning this: the tech sell-off, NASDAQ in freefall, the end of the growth era. They were right about all of it. They just forgot to mention the sector that was quietly up 64% in the same year. XLE 9 basis points, own it before the headline hits. Step 5. Consumer staples 10 to 15%. The beige cardigan of investing. People do not stop buying Tide detergent during a war. They cancel vacations. They postpone home renovations. They stop eating out. They do not stop buying Tylenol, Bounty paper towels, Coca-Cola, and Colgate toothpaste. Because it turns out human beings require caffeine, clean laundry, and pain relief regardless of geopolitical context. When the S&P 500 was down 17% through August 2022, XLP, which holds Procter & Gamble, Costco, Coca-Cola, and Walmart, lost only 4%. That's 13 percentage points of cushion, 9 basis points of expense ratio, a 2.5% dividend yield on top. Nobody is impressed by consumer staples. They will not make you look smart at a dinner party. They will absolutely protect your portfolio when everything else is repricing for the end of civilization. It is the financial equivalent of a beige cardigan, deeply unsexy, completely warm. Step 6. Inflation protection 5 to 10%, and a warning about the trap. Here is the most counterintuitive fact in this entire video, and I want you to sit with it for a second. During World War II, U.S. government treasury bonds lost 67% of their real value. The classic safe haven, the thing every financial anchor points to during uncertainty, one of the single worst trades of the entire war. Why? Because wars are inflationary. Governments borrow at scale. They issue enormous quantities of new debt. They inflate their obligations away over time. Standard long-duration treasuries get absolutely destroyed in that environment. TLT, the long-duration Treasury ETF, is exactly the instrument that gets crushed when inflation runs hot and the government is issuing war debt. Avoid it. What works instead? TIPS, Treasury inflation-protected securities, where the principal adjusts automatically when CPI rises. The ETF version is TIP, or for the most elegant version of this trade, Series I savings bonds purchased directly at TreasuryDirect.gov, zero expense ratio, fully inflation-adjusted, $10,000 per person per year maximum. There's a 1-year lockup. The lockup feels annoying until you realize it's the government structurally preventing you from panic selling your own inflation hedge, which, given everything we've discussed about panic selling, is arguably a feature. The one thing you absolutely do not touch, your index funds. VTI, VOO, SPY, whatever broad market index fund you own, untouched, contributions continuing automatically, not reduced, not paused, continued. CFA Institute data across every major armed conflict found that large-cap stocks returned 11.4% annually during wartime, higher than the 10% peacetime average with lower volatility. War economies are stimulus economies. The government becomes the world's largest customer. That spending flows into earnings. The market climbs. If you have a Roth IRA, a market downturn is the single best time to convert or contribute. You are buying tax-free growth at a discount. You make the contribution, you don't look at it for 6 months, and you quietly thank yourself later. This is the part the financial media never gets to, because by the time the recovery is happening, they've moved on to the next thing to be alarmed about. Jordan and Alex, where the money ends up. Let's close the loop. Jordan sold $45,000 in index funds at 8:30 a.m. on the morning the conflict escalated. The market fell 2.5% that morning and then closed up 1.8% the same day. Jordan missed the intraday recovery, sat in cash for 4 months. By the time the anxiety subsided enough to feel okay about re-entering, Jordan had missed the best stretch of returns, paid capital gains taxes on the sale, and re-entered after energy had already run 64%, after defense had already outperformed by 28 points, after the snapback was complete. Jordan captured none of the crisis upside, locked in the downside permanently via the tax bill. 4 years later, that $45,000 is worth roughly $54,000. Now look at Alex. Alex's original $45,000 plus the automatic monthly contributions kept running while the market was discounted, plus the tactical positions in XAR, XLE, IAU, XLP, and TIPS that were already in place before the crisis hit, is worth roughly $103,000. Same starting point, same news alerts on the same morning, a $49,000 difference. Alex didn't win by picking a stock that went to the moon. Alex won by being boring and structured in advance and then doing nothing dramatic while Jordan was being reactive and emotional. Alex bought the fear, Jordan paid for it. The decision you make right now. Here's the thing about the moment when the crisis actually hits: it will not feel like a drill. It will feel real and urgent, and like this time is categorically different. And some analyst with perfect hair will be on television explaining exactly why the historical pattern no longer applies. And for about 20 minutes they will sound completely reasonable. The person without a plan opens the brokerage app, sells everything, feels briefly smart, and spends the next 12 months watching the recovery from the sidelines. The financial channel that scared them into selling runs ads for the brokerage platform that processed the trade. The entire ecosystem profits. The person with a plan checks the structure they already built: the cash floor, the gold, the defense, the energy, the staples, the inflation protection, the untouched index funds, sees that it is doing exactly what it was designed to do, puts the phone down, and makes coffee. One of those people builds wealth, the other funds the system that was specifically designed to prevent them from doing so. The time to become the second person is right now, not when the missiles are flying. Not when the headlines are red, right now when it's quiet and you can think clearly and the decision isn't contaminated by fear. Build the floor, size the gold correctly, add XAR and XLE and XLP, set up TIPS, leave the index funds alone, write it down somewhere. And then when the moment arrives and your phone starts lighting up and every instinct you have is screaming at you to do something, do nothing, because nothing is the plan. If this reframed anything for you, if it changed how you're thinking about your portfolio or about the relationship between conflict and markets, hit like and subscribe. It's free. It takes 2 seconds. And unlike the financial media, I don't get paid when you're scared.